Welcome to this event. We're going to talk about startup, cash, budgeting, forecasting, all that kind of stuff. We have Scott on. He's the COO of Cruise Consulting, a startup CFO consulting firm, and he runs the venture debt consulting practice. Scott knows all sorts of things. He's helped Superhuman, Calm. You probably have more than 100 startups under your belt, right, Scott?
I think we're at 350 now.
There's a few topics I wanted to discuss. Let's first talk about forecasting. So I think you help companies when they're kind of talking to VC and they're thinking about forecasting. How do you, not talking about the kind of the cost side of it, let's first talk about kind of the revenue side of it. What do you think is like a good way for, let's say it's a pre-revenue company, so it's very early. How do you think is like a good way to think about forecasting? Like how many years out should you do? How should you like try to justify it?
A lot of founders get kind of flustered because they either are tempted to do like this ultra aggressive plan that, doing $50 million in revenue in 3 years, which I don't even think Facebook did that, right? Or their plan looks too small. And so then they're being too conservative and the VCs don't really want to fund them because it doesn't look exciting enough. So there's a careful balance in there. I mean, the best Silicon Valley startups can usually do like 1 million to 5 or 6 million to like 15 or 20 million in that 3 year. That's when you've kind of got product market fit and then you're in kind of revenue execution mode. So that's a framework that you can use. I typically like to use just 3 or 4 KPIs. And those will drive your model throughout. They'll drive your revenue, but also your hiring plans. So like if you're a SaaS company, you're going to use number of deals. You're going to use your average selling price. You're going to do things like what your churn looks like. So just those 3 KPIs can get you to a pretty solid model. Consumer, it's number of users, maybe you're advertising or maybe they're paying a fee, layering that in there. In the SaaS example, as you get that revenue plotted out, then you can start thinking about the headcount you need to support that. But we can get into that in a second.
Yeah, actually, funny story. In my previous company, we were doing a partners meeting in Andreessen Horowitz, and like we'd done this like revenue model and all this stuff. And I think it was like not that aggressive. I think it got to like 100 million in revenue after 10 years or something like that. And we had it up on like this huge projector, and like Mark Andreessen walked up to the kind of whiteboard projector thing, and he looked at it. He was like, "Yeah, that's pretty disappointing." I was like, damn, we got that wrong then.
Yeah, and you were trying to be like conservative and maintain your credibility. There's also a lot of great stories about at this time of year, because everyone's usually doing their end of the year board meeting, set the plan for next year, either board meeting now or first week of January. And you'll get these like, you present the plan to the board and they say like, not aggressive enough, go back and redo it. And it's such a heartbreaker, but like that's the reality of it. But I think the important thing to think about is the financial model, especially when you're fundraising, is really a tool for you to talk through the vision of the company, the milestones, and what you think could actually happen. So like, they're not so focused on just like the specific number, even to the thousands or 10,000s. They want to get a general gist of where you're going. And then, experienced investors will then use that to come back and kind of sanity check your milestones and also just see how aggressive you are, how ambitious you are, where you want to take the company. So it's almost like a personality test / ambition test / can you execute test? But the model and those numbers are the mechanism for starting and sparking that conversation.
How important is it that that market is like exponential, like that it's like growing by like a certain percentage every month?
The market or the company?
Sorry, the model.
Oh yeah. I mean, you definitely need to show like a nice clear path. If not, first of all, there's 2 aspects to your question. A lot of companies are not just kind of straight and up and to the right. There's bumps, especially in the early days. Like if you're a SaaS company, you may sign a couple pilot customers and then one of them ditches out on you. And so you've got this like bump. Or you may have one big customer who churns halfway through their deal. And so you just got to be realistic. Like people kind of glorify the up and to the right every month. That should be the case, but there's going to be some bumps. You're going to look back as 3 or 4 years from now, you look back on those tiny little bumps and they're non-existent. Like you don't even see them because they're so small and you're working off a bigger base now.
Yeah.
But generally speaking, his company was bought. He used to always say, if it's not up and to the right, something's wrong. And so you really got to go back in there and either check your accounting or sanity check what's going on deals and are you serving your customers correctly?
Yeah, that makes sense. How many years out should the forecast be?
I typically like to do 3 years. And this is another thing, like a little inside baseball thing. Investors pretty much understand you've got visibility for maybe a year, maybe 18 months. But the 3-year forecast, again, is a way for them to sanity check where you're going, how big of something you're trying to build. You'll get some investors who want a 5-year. I think they're kind of, the tough thing about that is that dance that you were doing, because you had a 10-year forecast. I mean, that's like kind of impossible. And so you're doing that dance of credibility versus being too aggressive. But if they're asking for it, I would definitely give that to them. I would just caveat it. I would explain it to them. And probably err a little bit on the more aggressive side than the conservative side. Like, you could also use public company growth rates. Like there's so many, especially in SaaS right now, there's so many SaaS companies going public that you can actually look at their historical growth rates and start layering that on your model in years 4, 5, and 6 and get a pretty good comp for it.
Is that, you're just talking about like looking at the kind of public filings, or is there like a nice resource for doing that?
Yeah, they're usually growing at like 50% a year or something like that. And so you can kind of just think like, hey, there's a couple public comps that are similar to my company. This is what their growth rate or growth trajectory was. It's also, as your company becomes a later stage company, that's really important, because I think you probably do a lot of angel investing too. Like in the early days, in angel, seed, Series A, a lot of it is about the concept. It's about backing the founders. It's about the vision. You're kind of in the honeymoon period, so to speak. As you start progressing to bigger dollar amounts and later stage rounds, it becomes a much more financial type of investor. They're really interested in like put $1 in, get $4 out type of methodology. Like that's what they're looking for. They're great at raising big sums of capital. They need to deploy it in companies that can use it wisely and grow. And so you need to be able to really convey where that money is going, what the return on it is. And they take your financial projections a lot more seriously. The good news is you've got a lot more visibility when you get to that point. You kind of understand your business, more. Like for Mercury, you probably didn't even think about Mercury Treasury 2 years ago. Maybe it was like a bullet point on a slide, right? Yeah. But now in your model going forward, you've got a whole, line item probably with the volume of dollars that are in there and what that's generating, and you can start predicting it probably a year from now. So don't stress out about it. I think there's probably one other thing I just want to point out, which is having a financial model, even if it's super simple, really can help de-stress your life as a founder. You've got so many things going. I mean, you're a founder, Ahmad, right? You've got so many things going on. Having like some guideposts and being able to run budget versus actuals every month on what you're actually spending, what your actual revenue is supposed to be, and what you actually did is an incredible management tool, because it's like, think of it as like an early warning system. Like you start seeing, it's actually funny. We see a lot of companies under hiring, like they have this really aggressive plan and all of a sudden their employee expenses are 30 or 40% below what they're supposed to be. And that's like an alarm that you're not hiring fast enough or something's wrong. Same thing with revenue, obviously. But just having those signposts are really, really important. You want to avoid the surprises for yourself and for your investors. The more comfort and visibility you can give your investors, the more kind of leeway or trust you will build with them. And that's really important, because you kind of want to have that reserve of trust, because something will come out of the blue and blindside you. And so you really want them to know you have a good handle on things. And that was truly something that blindsided you, not something that you could have predicted.
How often should you be like redoing your forecast and redoing your budget? Like, is this a yearly process? Every quarter do you reassess?
I'd probably say every 6 months. For an early, like for a baby startup, like a seed stage, probably once a year. As you're starting to progress, I'd do it probably every 6 months. Like for Cruise, for us internally, we're becoming a bigger company now. So we're doing it every 6 months. But again, you have that budget to actual. For those who don't know, once you have a good financial model, it's really easy to your account. Like this is what we do for tons of clients. We export out of QuickBooks all the financial information. There's a bunch of easy lookups and it shows your budget versus actual so that you have like a dashboard look into what your actual progress is. There's also some cool apps out there that are doing this. I think we haven't found anything that's like perfect, but there's things like Giraffe. There's other ones that you can start to use. I would recommend founders be very, very careful because sometimes some of those SaaS apps are built for like the power user, like the CFO at a Series C company that probably worked in finance at a public company, and they want a lot of bells and whistles. For you as a founder, you probably need something pretty simple. Again, you're looking for those guideposts. Like you can Cruise, we put up a free one-page financial model, basically an income statement with a cash adjustment. It's free. It's on our website. You just type in Cruise, financial model. As you start progressing as a company, or if you're a CapEx heavy company in the early days, you're going to want to have the balance sheet component. You're going to want to have the cash flow component because that gives you a fuller picture. For example, if you're a CapEx heavy, I was talking to one of our CEOs who's a robotics company yesterday, has raised like $100 million. And his biggest issue is not the month-to-month revenue, like that's subscription, that's tracking. He's got big CapEx requirements. And so seeing the balance sheet and the cash flow statement and seeing the actual cash outflow actually really helped him to the point where he started thinking about venture debt to fund some of that CapEx. So start simple, start easy, make sure you can actually use it. It's giving you value, and then kind of graduate into more complex financial models or SaaS apps.
Interesting. So I guess like talking a little bit about budgeting, I mean, most companies still, employees are going to be the main expense. How do you kind of budget that out? I mean, let's say, for simplistic kind of level, let's say you're paying someone $100K. How much more do you have to consider beyond the $100K for benefits, taxes, other things?
Great question. So the big other things you have are employer taxes. So everyone who, I get a paycheck every 2 weeks. And I look and I'm like, oh my gosh, the government's taking a big portion of my paycheck out in taxes. Oh my gosh. Well, guess what? Your employer, Mercury or Cruise, is also paying taxes on top of that number. The government kind of double dips. And so if you add in employer taxes and you add in health benefits, those are two pretty big kind of chunky expenses. At early stage companies, like early stage, they typically hire kind of younger people because they're typically engineers and, that's who they can recruit. And so the benefit expenses are typically somewhere around $400 to $500 a month. Like we've done some studies on this at Cruise. But as you start hiring older ladies and gentlemen like me in my mid-40s, my healthcare premiums start going up. Like I think I have to pay $600 or $650 a month just for my stuff. And so you can see how, as your company matures, you start hiring more senior managers, directors, VPs, your health benefit costs are going to go up. We typically recommend companies budget basically an extra 20 to 25% of the salary to include benefits, to include employer taxes. A lot of startups do not, they'll create a 401k program, but it's rare that a startup does matching. It's more like companies like us that are like bootstrap cash flow businesses that will do, like we do 2% matching at Cruise and 401ks. I don't really recommend startups do that. Startups have option plans to increase the compensation for employees. And if you're doing those 401k contributions, you're kind of like giving the venture capital. It's not a great, you obviously want to retain people and take care of people, but it's like, that's more venture capital money that's kind of leaving. So it's better to pay people a really healthy salary, give them options. That way they have upside. And then just make sure you're budgeting for those health benefits and taxes.
Mercury actually did 4% 401k matching from day
That's
zero.
amazing. 4%? Wow.
That's the maximum, I think.
That's the highest I've ever heard of. I even like public companies don't do 4%, I don't think. Wow.
Well, I really like benefits that are like tax, not tax free, but like tax or whatever. Because it's just all upside for employees.
Yeah.
They can still take it out. Like I I mean, I would actually prefer getting 4% less salary and 4% matching.
Oh, totally. Totally.
That's like the rational choice.
We did it because the matching is really powerful. If we'll just kind of sidestep for a second, if you're someone running a company, the matching can be powerful because it really encourages your team members to save for the future. And I know, like in the early days of Cruise, we had kind of more younger people working, and I would look and they weren't really saving in their 401k. And so that's when we introduced the matching to create this like really turbocharged incentive for them to save just a little bit. I know looking back on my life, like the money I saved in 401ks when I was like 21 or 22, like that's had 20 years to compound now. Like it really does pay off. Just getting that money in the market and having it work is really powerful. I mean, it's kind of like Mercury Treasury is kind of an offshoot of that, right? Like making it easy for people to for startups to invest their cash wisely and do it kind of an automated way is you can do like the set it, forget it kind of mentality.
Let's talk about budgeting a little more, and then we'll come back to Treasury. So we talked about 20 to 25% above kind of salaries to think about kind of employee costs. Obviously, you have to factor in then like, well, how much is your average employee cost? How many you're going to hire over the next 6 months? How far do you budget out generally? Like 12 months or?
We'll always do 12 to 18 months, and then we'll do the 3 years. I think it's good to do the 3 years. So a couple things on that. You're right in that employee expenses, like direct salary expenses and the benefits and things like that, they tend to be about 50 to 75% of a startup's spend. And it kind of makes sense, right? Like all of us are pretty much in the business, even in Cruise, like we're a startup too. And we're all building software. We're all automating things for our customers, but human beings have to build that. And so that's going to be a really big chunk of your cost structure. The other stuff that people should just think through is really like your web service spend. I mean, that's going to vary, but it's your hosting. Hosting typically actually goes in cost of goods sold, but things like all the software you're consuming and using. And then another bucket that you should really think, let me go back to that for a second. That's another place where budget actuals actually can be super helpful, especially for the CEO. There's been times that we've been working with companies where the CTO is, kind of a gadget person, and they're trying a bunch of different software apps and trying a bunch of different things. Or maybe one of the engineers forgets something in AWS and leaves it on. And all of a sudden you see this explosion in expenses. And if you don't catch that within a month or two, it could actually like really cost you a lot of money. So keep an eye on your web services. One of the CEOs I really liked, the company was bought, he used to sit down with his CTO every 6 months and just go over what they were actually paying for and using, just to make sure there was some sanity check there. But then the other thing that has really kind of dramatically been reduced is, kind of staff perks or office expenses or meals and entertainment, like that bucket. That was something that when we were all kind of going to offices back in the day, especially engineering heavy companies, you'd see a ton of Uber expenses, right? Because engineers are working late. You see a ton of food expenses. You'd see a ton of like the office kind of snacks and chips and things like that. And so that has gone down as none of us are really working in an office these days. But that's something to keep your eye on. It's a great perk. It's something to incentivize some of these folks to work later at night. Totally respect that. But that's a bucket where you can start seeing dollars leak out if it's not monitored.
And then you're saying that with at least the budgeting side, you should almost look at every month to see like at least each line item is like vaguely what you expect it to be.
Yeah, I like to do the budget to actual every month because again, and it's so easy to color code these things. You can quickly see what's on target, like the green, and what's off target, the red. And so the CEO might only need to spend 15 minutes on it and just boom, 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 maybe click into something, see what's going on there. But doing it once a month, so much of like, especially startups, is building habits and just it's like the best startups always send their investor update out within the first 10 days. Like I have done a lot of angel investing. There's a clear correlation between that. That's a muscle memory. That's a discipline that the startup founder has instilled in themselves. Same thing with budget actuals. I typically do our budget actuals between the 10th and the 15th of every month. So you've kind of gotten out of the hectic first couple of weeks. You have some time to look at it. the books are closed, and you can look at the budget to actuals. And so it's not going to take a lot of time if you're checking it once a month. It does take a lot of time if you check it every 6 months. And there's a little plug I want to put in for all the accountants everywhere. At Cruise, when we deliver your monthly financials, we also encourage you and want you to book a 30-minute call with us, or like a Zoom. And we actually make that free. And the reason why we do that is there's a buildup of questions every month on like how to categorize certain contractors, or what's this CapEx, or maybe some of these invoices are a little wacky. Whatever those questions are, tax compliance is a huge one. You know, hey, you're ready for your R&D tax credit right now. Let's get that going, that kind of stuff. And the companies that I see having trouble are the ones that kind of ignore those questions for 3 months or 4 months. And so the little thing that could have been answered 3 or 4 months ago with a 1-minute answer on a question sheet or in a conversation has turned into a big thing. And all of a sudden you're kind of questioning the numbers, or you're spending a lot of time to go back and fix things. It's probably driving your accountant crazy because they're taking their best shot at everything, but you're letting the issue snowball. And so I just think that like getting in a good habit and doing it once a month will make your life so much easier. And again, it all kind of comes back to like building the confidence in investors and de-stressing your life. It just makes things easier.
Yeah, let's talk about Mercury Treasury a little bit. So Mercury Treasury, just for those that don't know, is a new product we just launched. Basically, it's kind of like a wealth fund for startups. You kind of, if you have like 5 million with us, you can say, hey, put 4 million into kind of US Treasury bills or money market funds, and we'll kind of automatically allocate it for you. But we also have kind of nice dashboards so you can see what yield you're getting and all of that kind of stuff. I was just talking to Scott a second ago, and he was saying like how companies do this before Mercury Treasury. So I think I guess firstly, what size of company used to do some sort of money management, money market stuff previously?
It's usually the companies that have raised a very big round, like a $15-20 million and up round, because they've got a ton of cash sitting around all of a sudden. And they know that's probably 2.5 years of burn rate. And so all of a sudden they realize they need to do two things: start generating some interest on it. But I don't think, and I know you probably agree with me, generating interest is not the number one goal. The number one goal is keeping it safe and making sure it's there when you need it. And then generating some type of income on it. Because I've done this analysis a bunch of times. Like when a company raises $20 million, even at interest rates being very low these days, you can still generate enough interest income to pay for an additional engineering hire for the year. So this is something that can really move the needle for you in a way. And what I like about Mercury Treasury is, when I work with other banks and companies raise a lot of money, I have to have this full-on conversation, multiple phone calls or Zooms. I have to review a bunch of documentation. And really that's coming from a different group than your normal banker. It's the money market people or the capital markets people, and I'm fairly sophisticated. I have an MBA and a CFA, and even I have a hard time with this sometimes, let alone, your prototypical engineering founder or sales founder who it's just not natural for them. And so I think what you're actually doing a tremendous service, because I know you share the same values as I do, but you're making it kind of easy, set it and forget it, make that allocation, and it's easy, it gets done. It doesn't sit around for a while waiting to be put to work.
Yeah, exactly. I mean, I really hate talking to people. So a lot of Mercury is about I like talking to you, Scott.
I'm honored that you're talking to me. Thank you.
But if I can avoid talking to bankers, it's always a good thing.
I will tell a quick story on the importance of safety for your capital. When I used to work in venture capital before I joined Cruise 5 years ago. I did venture capital for 9 years, working at a venture debt fund that also did equity. So I funded Angie's List, Upwork, Impossible Foods, a bunch of companies. And when the 2008-2009 crisis hit, there had been a bank, I'm not going to name them, but they're a major Silicon Valley bank that had been selling auction rate securities. Are you familiar with those? You know what I'm talking about?
No, it doesn't sound good.
So in 2008, 2009, it was a way for companies to put their cash into very high yielding but safe bonds. Well, when the financial crisis hit, the auction rate security market failed, and we had companies that had 30, $20 million locked up in a failed bond market. They could not get access for a year. CEOs and CFOs were getting fired like crazy. It was a really ugly period. And so that was, 10 years ago for me, 12 years ago. So ever since I saw that happen, I realized how important safety and just making sure the money is there for when you need it.
Yeah, you can't do any exotic stuff with it. Actually, it's
No,
funny when we launched Mercury Treasury, like, I don't mean to speak badly of anyone, but like there was a bunch of like, oh, why don't you make it so you can put in Bitcoins? And I'm like, this would be a completely unreasonable thing for a startup founder to do with their
totally.
VC money. And, I'm a big fan of crypto, but like there's not the right kind of application for it. I was just going to say, I think I don't like talking to bankers, so if we can automate it, it's better. And B, I have a lot of friends who raise money, and if you haven't raised 20 million, you can't even get that meeting, right?
Oh
Like,
yeah, totally. Yeah,
like you have to have a sizable chunk before they'll give you access to this
I
product.
know. It's crazy, right?
Mercury makes it accessible to anyone who's raised like basically 250K is our limit, but
Nice.
just because we have some fixed costs associated with it. There's a question from Andre. He's basically asking if you miss paying taxes or declaring taxes to the IRS, what's the procedure? Like, how much penalty can you get hit by?
Yeah. Well, first of all, the IRS or any other, like California one, are really good at figuring this stuff out. And so they probably will figure it out. I actually got a statement from the IRS on Cruise's Q1 2020 payroll tax filings saying that it had been wrong by 18 cents. Luckily, we had overpaid, so I didn't have to send in 18 cents. But that's the kind of stuff. Now, the good news on that is you're not going to get like a crazy penalty or anything like that if it's a de minimis amount. The areas I see companies getting in trouble are they forget to do their Delaware franchise tax, which can make it so you forfeit your corporate entity and therefore you don't have any liability protection. Or they will forget to do their California franchise tax, or think that they're going to try to game it and not register in California even though they're here. California has your social security number. The IRS has your social security number. They compare that with bank records. You probably know this from when you start a bank account, and you probably see these direct debits from California hitting some of your clients. They just take the money out of their account a couple of years later. And so, obviously, especially if it's a good-natured, you made a mistake, didn't realize you were making a mistake, you're going to be totally fine. It's going to be fairly easy to clear up. If you're getting dodgy or just forgetting, then you make it right as soon as possible, repair the damage. You don't want to go down that like endless demand letter, you're in trouble with the IRS or states type of email or letter chain. It just gets so hard to unwind that and fix it.
Yeah, that makes sense. If you're a non-profitable startup, which a lot of these are, what taxes do you have to pay? There's payroll tax, there's franchise taxes. Are there any other kind of taxes that you should be worried about?
There are a few others. So if I may, we have dedicated tax calendars with the deadlines for every material tax deadline for basically all the startup hubs on our website. So you can type in Boston's, startup tax deadlines, or Seattle or San Francisco. You'll end up on our website, has every deadline. The big ones you need to worry about are 1099 notifications of what you paid your contractors. Those are due January 31st. There's really big, I think the fine's now $2,000 per notice not sent. It's pretty big. The next one you need to worry about is your Delaware franchise tax, which depending on how much capital you've raised, can be as small as like $400, $250, all the way up to like $10,000 or $20,000. So you need to file that every year though. The next one is and that's due March 1st. The California franchise tax is due April 15th. And that's if you're operating in California, you're a foreign corporation, you have to file that. Again, they'll take it out of your account later and more if you don't. New York, where we have a lot of startups, I can't remember I think their deadline is March 31st, but they have a version of the franchise tax. And they also, New York City has some payroll tax and gross receipts tax.
nowadays, if you don't have offices, like what's the definition of operating in California? Is it just if you have any employees here?
Great question. If there's a couple different ways to create tax nexus, and we'll talk about sales tax in a second if you want, but for just plain old, federal and state income tax filings, if you have, basically you establish nexus is if you have employees, not contractors. There are some cases where contractors could trigger it, but it's more rare. Employees, assets, or property, or potentially a lot of revenue. And the new revenue is a new one, which you can talk about in a second. But basically, if you have an employee and they've got a laptop and an office and all that kind of stuff, odds are you're going to need to start filing. The moment you register, remember how you and I were talking about registering in other states at the beginning? That triggers, the state knows you registered and you probably have someone there. And so they're going to be looking for that income tax filing. Now, the cool thing is the federal, when you do your federal taxes, and by the way, you have to do that even if you're losing money. The good news is you can attach an R&D tax credit to it. We did $8.5 million of R&D tax credits last year. So you actually usually get money back. But you'll do your federal return, and then the state returns will kick out like in our tax software, and we'll do those filings for you as well. But we were like right now, we're running all these Nexus studies in our clients' payroll systems and also aggregating the dollars for R&D tax credits so that we can send, like all of our clients right now are getting emails saying like, hey, Ahmad, we're just about ready to get filing your taxes. These are the states we see you having Nexus in. Are there any others? And so you want to pay attention to that. There have been some cases where with COVID hitting, for example, New Jersey basically created a safe harbor so that if people from New York were moving to New Jersey on a temporary basis, they didn't have to register. There's a bunch of that happening right now. I'm kind of expecting that there'll be, if the vaccine isn't out fast enough and things like that, there may be some further clarifications on that, but that's fine. The one caveat to that is a lot of, like for our team members, we had someone move to Wyoming, Virginia, 2 more to New York, 1 to Texas, and I think I'm forgetting someone. All those states except for New York have, actually New York does too, have lower payroll taxes than California. So they all requested that we start listing them as working in that state, which then triggered a bunch of state filings that we had to register. But for the employee, that's actually better. They're paying lower state payroll taxes.
Sure. Well, do you have to pay franchise taxes in all those states if you have it?
Variations of it. Not all states have franchise taxes. A lot of them are like $100 or $200. California is the biggest. Yeah. And New York is decent size too. But you usually have to pay like a $50, $60, $100 kind of thing annually. And that's part of, that's, again, California and New York are the 2 highest taxed, and San Francisco City and New York City also have versions of payroll taxes and gross receipts taxes. So there's that third level below states, which is the municipality. I know this is a lot of information, but again, you can just check out the tax calendar on our website and it'll help you.
Yeah. You mentioned R&D tax credits a couple of times. I think it'd be useful to just, I actually didn't know about them when I first started doing startups. So I don't think everyone does know about them, but they're great. So it'd be useful for people to get a version of what they are.
Well, so the background on those are, they've been around for a long time, but about 3 years ago, the Treasury and the IRS got together and said, they used to make it so you had to be profitable to use the tax credit. And they said, there's all these startups out there that are spending money on R&D. We should let them use this against their payroll taxes, specifically the Social Security component of the employer. And I think I forget the number, but I think it's like around 6% tax or something like that. And so all of a sudden we've been doing R&D tax credits, I think this is our 4th year. So it's probably 3.5 years ago, doing them since then. And basically you can capture a credit on a percentage of your employee and contractor spend that are building true R&D. So it can't just be like a designer making something look prettier. It needs to be true R&D. You typically want to allocate the exact projects by employee. And like you typically in a kind of general way will allocate maybe 80 or 90% of someone's salary to R&D if they're like a hardcore engineer. I've had some CEOs over the years try to make themselves 100% R&D, and I'm like, hey, you're raising money, you're running the company. There's no way you're doing R&D all the time, right?
So you can get up to 6% back on employees? Is that effective?
Well, the way it works is there's a cap of $250,000 on the R&D credit. And so we do have companies that exceed that, but we actually ran a study, and our average R&D tax credit is $45,000. But if you think about it, like, we've saved our clients $8.5 million of burn rate this year, which is pretty material. And so the other things I would say is I would really recommend working with a CPA firm, whether it's us or not. The R&D tax credit is part of the tax return. We have gone through audits on the R&D tax credit. And so if you have someone who's kind of a fly-by-night or whatever, they're not going to be in a position to defend it. And really, we don't really accept outside R&D tax credits because, like, our CPAs are signing the tax return. Like, our credibility is on the line. We lose our license if something is fibbed or inaccurate. Like, we don't want to take that chance. Yeah. And so just work with someone reputable. But it's a great way. And once it's filed, especially with Gusto, they have a great way of as soon as we file the tax return, we go into Gusto, we apply the R&D tax credit, and you can select an option where you stop withholding immediately. So you get the benefit of that R&D tax credit immediately. It's really awesome. So if you're not doing them, I would, feel free to email us, but also check out our website. We've got a lot of information on it, but it's a way to lower your burn rate. Yeah.
And for people who don't have someone like Scott, there's a couple of like software services that are doing it. It sounds like Scott doesn't like them maybe, but there's a company called Main Street. There's another one called NeoTax that's kind of trying to automate R&D tax credits. Let's answer a couple of questions. Julian asks, how do I know if I have to file quarterly reports to IRS and pay taxes on them? I assume Julian means like quarterly versus...
Yeah, you don't have to. So if you're profitable, then you do have to pay estimated taxes. I think at Cruise, we've got like 5 out of 350 profitable companies. So there's not a ton of startups that are profitable. But if you are, or if you're bootstrapped and you are profitable, then that is an issue. So make sure to, your accountant, again, should be giving you estimated tax projections. Sometimes we have companies that have like amazing years and they swing into profit mid-year. So we have like a system internally to flag that and then start doing the estimated payments. The penalties are actually pretty small. So it's not like going to change your life or be horrible for you if the first year that you swung into profit, you didn't do estimated taxes. It's just a good thing to do. It's a best practice, and you can get a safe harbor. It's just nice as long as you're kind of making that effort and paying the appropriate amount.
Yeah, that makes sense. So if you become profitable even for a quarter, you can't just wait till the end of the year. You might need to like start paying at the end of that.
Well, if you're only profitable for a quarter but lose money the rest of the year, then you're fine. As long as you lost more money over the rest of the year than that quarter. It's on an annual basis. But if you swing in the profit, and it's like, say you swing in the profit the second quarter, and then Q3 and Q4, it's like, wow, that's a really, you're going to have to pay, you're going to be profitable for the whole year. So you should better make that payment now.
Got it. And this is going to show how long I've been doing startups, but like, what is the tax rate for startups being profitable?
Well, tax rates are the federal tax, the tax rate, and then the state tax rate. I think federal is capped at 30%, maybe 28%. And then state is, depending on what state, but I think California is like 12%, something like that. Okay, but again, so I really like, there's not many companies that are profitable. So it's more about filing the tax returns. The biggest confusing point is some founders think that if they're not profitable, they don't have to file a tax return. You do have to file a tax return. The IRS wants to know. And there's one other thing we should talk about, which is foreign, like companies have a Delaware C Corp, but have foreign owners or owners that have a subsidiary or the subsidiary in another country. Either of those will trigger a 5471 or a 5472. There's 2 different forms of the IRS. And it basically asks for either information on the owner or information on the subsidiary. If you fail to file those along with your tax return, then it's a $20,000 fine per form per year. So we have a lot of companies, like this happens with Stripe Atlas a lot. I know Stripe has really helped a lot of people doing Stripe Atlas, but companies will incorporate foreign founders, not realize there's some filing requirements by the IRS, and then come to us and be like, hey, I didn't do my tax return last year, and we'll look and they owe $40,000, boom. Now, the good news is you can get that abated, but it's a pretty arduous task. You have to file a lot of letters and do a lot of phone calls to the IRS. Only in the first year can it be abated. Every year after that, you're stuck paying that $40,000 fine if you didn't file those forms.
If you are like bootstrapping, like you really haven't raised money, maybe you don't have employees and it's relatively simple, but still you have expenses, let's say, and you've kind of funded it yourself. What's a good way to manage it and like keep it good so that if you do raise money, it's as easy as possible to work with an accountant to be like a bit more solid?
The simplest is if you can teach yourself QuickBooks. There's some really cheap QuickBooks subscriptions. I think it starts at like 20 or 40 bucks. And it's not that hard. It's a little bit of a pain, but just import the bank transactions, kind of allocate them as you should, and create a simple P&L. We also have a lot of founders coming to us where they download their bank statement every month in a CSV and just kind of do a quick little, figure out their burn rate, and that's enough for them. And they can kind of see the big charges like employee payroll and things like that. So those are the simple ways of doing it. Again, you can get away with that for a while. And we're the kind of firm that we don't want to like just kind of take your money. So we'll often tell companies like you can get away, or we have companies coming to us now where we start the onboard but we know we're really going to start delivering like January financials. Like it's kind of planning ahead. And then the final thing is a lot of companies, they're kind of like, again, we're encouraging them to save money. They sign a term sheet or they're about to sign a term sheet. That's when they kick into gear and call us and say, hey, I'm closing on money in 2 weeks. Can we start working on this? And we're happy to take that business and do it for them. Because the VCs will look at it and be like, I love your concept. I love where you're going. Can you get your financials in order with some of the money that I'm giving you and make sure your compliance is done correctly?
So basically, like as long as you either use QuickBooks or spreadsheets or something, and you like tag out each transaction, you can like normally figure it out later.
Yeah, money can always solve those problems. It's just to what degree. We actually are not. Sometimes people come to us with like 2 years and it's horrible, and they think like we are enjoying all this cleanup work, but actually it's like gross margin negative because it's like the worst work, and our team doesn't really enjoy doing that. And so we have to kind of explain that to them. We're kind of giving it to them in bare bones and to get them in the flow and get them set up. Our goal is to get you set up on the right systems, Mercury included, and then also allow you to grow without having to worry about switching a bunch of systems. And you kind of do set it, forget it, do your 30-minute call every month, look at the budget to actuals, and your financial life is really de-stressed.
Yeah, you're making it sound easy. We have a question from Ellie. She's asking, if you do put some company assets into Bitcoins, or I guess other crypto, how do you do the accounting for it?
Yeah, we are not crazy about doing that. We will accept clients that have Bitcoin or things like that, where it's just kind of sitting in a savings account or not really changing. Where you get in trouble is when you're trying to use Bitcoin or some other crypto to pay your employees. We've had a few of those. And because it's so volatile, the actual true amount, like on a dollar basis that you've paid someone, takes a lot of figuring out. And so we've kind of avoided that. There's also, you probably know this, Ahmad, you're subject to this, but there's some KYC, like know your customer, money laundering types of things that we worry about. Again, we are filing a tax return with our CPA's signature on it. We can't be like screwing around and having someone doing money laundering or weird things like that when we don't know about it. So we're pretty careful on that. I would say if it's if it's your personal assets, do it, go crazy. I own a little bit of Bitcoin, but if it's a company, I would just keep it in dollars or convert it into dollars and not really worry about it.
Okay. But if you're just holding Bitcoin, you're not kind of trying to use it for actual transactions. That's pretty simple from an accounting perspective.
It's probably okay, but if we start seeing transactions in and out, that's where we get concerned about money laundering and things like that. And so we usually ask them when you start talking to the founders through it. We just had another one like 2 weeks ago. It was like this. He had done a bunch of his company had done a bunch of consulting for a very large crypto like company had done an ICO. And so he got paid in the ICO, like the token. And we're like, it was liquid. We're like, do you really want this on your balance sheet? Like, and he's like, you're right. I'm just going to convert it all to dollars, because that's what he pays his employees with.
Yeah, that makes sense. Let's see. We have a question here from Benjamin. What method do you use to determine how much office space a company will need to lease, and how much money should you allocate to their real estate costs? I mean, right now,
Yeah, that's more of a founder question. I'm kind of someone who I like people to have I believe that like office is helpful, but we're a distributed company. So like, I believe in this model. Now, some people want everyone in the same roof, and there's definitely benefits to that. But we used to have an office on Kearney and Pine and pay $25,000 a month. And it was really an expense that we didn't really need to do. And as long as you invest in that distributed culture and have all the right processes and have set up the safeguards, you can make that work. Some people like kind of the tight energy of having people under one roof and not a huge space. Other people want a lot of big space. So there's lounge areas or places to get away from your computer or have guests. It's really a personal opinion, and really with the startup founder. There are some really good, I'm blanking on some of them I've done some podcasts with some really excellent real estate folks who have some metrics on that. So if you have that question, shoot me an email, I'll connect you to the real estate folks. But I think they do have kind of metrics per employee, what your office space is supposed to cost.
All right, we're running out of time, so let's do a couple of quick ones. Is it really necessary to do an 83B election as the founder?
I'm so glad you asked me this. I saw this come up. Yes, file the 83B. Do it within 30 days.
But it's only if you have vested founder shares, right?
Or if you're getting founder shares or restricted stock that you can that you're going to vest over time, but you can lock in the price just then. But we see it's almost like it's like we see companies come to us. The founder didn't do the 83B. They spend $10,000 or $20,000 on legal expenses. It's very difficult to fix. It's very hard to do. So the key thing is you need to send that to the IRS, and you need to mail it, and keep that certification. The IRS can lose stuff. You do not want to have like an IPO and 10 years from now realize you didn't certify that mail and the IRS can't find your 83B. So super important to certify that.
I think the same person, Ezeki, is asking if they received a EIN number 6 months late. There's lots of issues with the IRS and EIN numbers right now. Should they file the 83B now that they've received the EIN number?
That's a great point. I have heard that there's a lot of issues with the EIN numbers. And so, especially through Stripe Atlas, because I think the IRS is having some problems. I don't think it's on the Stripe side. And so I would file it as soon as you get that number, just file it, put it in the mail, again, certify it, and you should be fine.
Yeah, the funny thing is it's a lot of it seems to do with intent, right? Like that was my sense of the whole 83B thing. Right?
Yeah,
you just tried your hardest, and that's good enough.
Yeah, you just got to do it, and it literally will take you less than 2 minutes to fill out the form. It's so simple, and it just there's so many. It's a good kind of it's like a marshmallow test in a way for founders. Like, can you complete some of these tasks that will make your life a lot easier now, or a lot easier in the future? Can you get them done now, or are you making excuses or just not doing it? Like, just please do it. It just makes your life easier.
All right. Julian asked if a foreign founder is foreigner working from his country, can he be an employee and do payroll through the US entity?
He's a founder in another country.
Yeah.
It actually depends. Probably not. You probably have to use what's called either a global PEO, which allows you to piggyback on an entity that's already been set up by this PEO entity, or you have to create a subsidiary in another country. There are times where we see founders try to pay themselves as contractors, which the IRS really frowns upon, because they look and they say, like, you own a bunch of equity in this company. Like, how could you be a contractor? And the IRS interprets that as trying to avoid payroll taxes. And again, they're good at figuring this stuff out. So if you're in another country, then you probably need to do global PEO, or you need to do a subsidiary. I recommend the global PEO, by the way, like strongly before you start setting up subsidiaries. The subsidiaries create that tax complexity I talked about, and also it's expensive and takes a lot to wind down.
Yeah. Marie recommends remote.com. There's also Deal. I think that.
Yeah, I've seen both those. Globalization Partners is a really good one. I actually have a podcast with Nicole, who's the founder. We refer a lot of business over there.
Yeah. So these are global PEOs that help
global
you.
PEOs, yeah. It's a new phenomenon, and it's becoming very, very popular.
All right. Let's do one more question. This one's kind of a tricky one, but let's see if you can do it quickly. We have activities in a few countries, including the UK. How can we manage taxes related to every country, and how can we prepare for the impact of Brexit? Maybe let's just do the first part, because Brexit.
Yeah, I don't know anything about Brexit, so I'm the wrong guy to ask about that. In terms of this is a pretty common situation. We have probably 20%, 25% of our founders have a subsidiary somewhere in another country, and then are working with us on the Delaware C Corp. What we recommend is you hire a local accountant, kind of like a version of Cruise in whatever country, especially the UK. There's a few firms like this, like us there. They will handle that subsidiaries, essentially their accounting, like the profit and loss statement, balance sheet, and they'll also handle your local tax compliance. And then that will be folded into the Delaware C Corp's, either financial results. Either you consolidate, like most companies consolidate like every 6 months at the early stage, or once a year for tax purposes. Bigger companies will start consolidating every month, but that's the way to solve that. I've never met a firm that can do all of it, except for maybe the Big Four, which is gonna they probably charge 10x what we would charge in the United States. So it's just not worth it. And we have some partner firms we can refer you to that we refer over. Awesome.
But this is great, Scott. If someone does want to get in touch with you or Cruise, what's the best way they can do that?
Yeah, just shoot us an email at Scott@Cruise Consulting, KRUZE consulting.com, or you can just go to our website. We have a lot of stuff we've covered here. Actually, we have on our website. We try to, we are emotionally vested in the startup ecosystem. I did investment banking, did M&A at Hamburg and Quist, then did venture capital for 9 years, and now Cruise. I've only worked with startups. That's all we care about. So come to our site, check us out. If you want to work with us, there's you can fill out a lead form there, or just shoot us an email, and we'd be happy to give you just a free diagnostic, give you a quote. And if it works for you, great. If it doesn't, we totally understand. Sometimes companies come back 6 months later, like, I'm ready to go now. I know what I want. And that's a great situation for us.
Awesome. Thanks for attending, everyone. All right. Thanks, Scott. Talk soon.
All right, buddy. Thank you so much. Appreciate it.